Would you believe us if we told you there's tons of money to be made by investing in bad companies? And we don't mean evil corporations. We mean companies that are failing. You see, most people wouldn't think of buying stocks in a company that's about to collapse. But that's exactly what short sellers do. They trade in undesirable stocks, or more precisely, stocks that are about to become undesirable. It's super confusing, but don't worry. In the next couple of minutes, we'll demystify short selling and explain why this risky branch of stock trading can be so lucrative. Let's start with the basics. What does shorting a stock actually mean? And how does it differ from going long? Put simply, short selling is betting against a stock. It's the exact opposite of traditional long selling. When you short sell, you predict that a stock will lose its value sometime in the future. So you borrow it and sell it when you think its price has peaked. You're probably asking yourself, how can you sell something you've borrowed? Here's how. When you borrow a stock, it's technically yours to do with as you please, but at some point you will have to give it back to its original owner. There are also some strings attached, but we'll talk about them a bit later. For now, just remember that when you borrow a stock, you own it temporarily. Now that the stock is technically in your possession, you need to sell it before its value drops. Selling the stock while its value is at its highest is a crucial aspect of short selling. When you sell the stock, you'll get an amount of money that equals the stock's current worth, obviously. Now all you need to do is hang on to this money and wait for the stock's price to drop. When the price drops, you buy the stock for real, give it back to the person you borrowed it from, and keep the difference. So imagine if the stock's value fell to zero. You'd get to keep everything. Pretty sweet, huh? If you were to successfully short sell hundreds or even thousands of stocks, you'd strike it rich. Yeehaw! Whoa there, cowboy. Hold your horses. Don't start scouting for shrinking companies just yet. First, you need to know just how risky short selling is. Spoiler alert, it might be the riskiest thing you ever do, like even riskier than swimming in a swamp full of alligators. Please don't go swimming in a swamp full of alligators. The first way short selling can come back to bite you where the sun don't shine is when you get your prediction wrong. Instead of falling, the price rises and you lose. The more the price rises, the more money you have to spend to buy back the stock. And remember, you absolutely must give it back to its actual owner. Theoretically, this way you could lose an infinite amount of money, since there's no limit to how much the stock price can grow. Okay, you might think, no biggie. I'll just wait until the price starts dropping and give it back then, so I don't lose any money. I might even make a profit after all. Not necessarily. You see, there's another way short selling could backfire on you. The lender can ask for the stock back at any point. This most unwelcome of outcomes means you've now wasted not only your time, but your money too. That's because even if the price remains exactly the same, there are still costs you have to pay for borrowing a stock. That sucks. However, there is a silver lining to all this. Remember how we said that you could lose an unlimited amount of money in theory? The reason why we added "in theory" is because there's something that significantly diminishes the possibility of you suffering such massive losses. It's called maintenance margins. Here's how they work. To be able to short sell a stock, you first have to deposit a certain amount of your own money as a buffer. This money is used to cover potential losses. Naturally, it's still your money. It's just there as insurance in case anything goes wrong. That gives both parties some breathing space if the worst comes to the worst. Now that we know exactly how short selling works, we need to address the question that's on everyone's mind. Is the potential for profit worth the unlimited risk? That all depends on how experienced you are. If you're a battle-hardened Wall Street trader, you can earn a fortune by successfully shorting a stock. But if you have no idea what you're doing, you could lose everything. Of course, sometimes even the experts get it wrong and lose an amount of money that's tough to earn back. So, does that mean shorting is only for finance legends like George Soros? Nope. Short selling is a well-established part of stock trading. Experienced traders combine both short and long selling to get the maximum out of their investments. That said, as with all risky business in the world of finance, Short selling is best approached with caution, patience, and above all, experience.